The third and final part to 8C again looked at reducing balance depreciation, and again you were given the graph, and it was for a computer, and we can see it's been depreciated using reducing balance. So that wasn't actually, didn't need to figure that out ourselves, they told us that, and we figured that out because we could see the depreciation each year got less and less and less. So I went from there. There's the carrying value each year. So in the first year, depreciation was about 20,000. In the second year, it was about 12. In the third year, it was about 7, and so on. So if the depreciation is getting less every year, that must mean we've used the reducing balance method. What we're asked to comment on here was explain how in year 5, using the reducing balance method would affect the income statement. And what that means is, well, in that last year, we're going to depreciate at about $2,500. How does that compare to if we had a used straight line? And the problem here is we weren't given any alternative numbers. We couldn't go and figure out how much straight line would have been every year. So we didn't need to put any numbers in our actual answer. But what we just needed to remember was the principle. The principle of the sort of depreciation methods is that if I use reducing balance, which we did in this case, the depreciation was 20 grand. Now I don't know what the straight line was, so I'm just making this number up. But the point is, as time goes by, the straight line method will stay the same, but reducing balance will get less. And that's because we assume that the revenue earning capacity of this asset, it's going to earn less revenue as it gets older. So we should charge less depreciation. So you can see in the first year under reducing balance, we charged 20, and by the end we actually only charged about $2,500. Compare that to straight line. Now we don't know what this number would have been, but we know that it would have been the same for the asset's entire life. And what we know is two things. We know that at the beginning, the straight line amount will be less than reducing balance, and we know that at the end, the opposite's true. Straight line will actually charge more depreciation than reducing balance. So that's what we need to talk about. We don't have numbers to back this up, but we can still talk about it. We can say the depreciation expense would be higher in year 5 if I used the straight line method, and that's because we would have allocated the same amount of depreciation every year, whereas reducing balance decreased over time. It still haven't really answered the question, which says how would the income statement be affected. So we've said the depreciation expense would be higher. So what's the effect in the income statement? Well, overall that means our net profit will be lower. So we need a second mark there to show that a student understands that just because depreciation expense goes up, what's the impact? The impact is that your net profit will go down. Looking at the mark breakdown, a lot of students had trouble answering this. Not having any numbers to back up your straight line depreciation probably didn't help. A third of students managed to get the 2 out of 2. Looking at the examiner's comments, students needed to explain how the income statement would differ, but also talk about the 2 changes. So one was higher depreciation expense, and secondly, that must mean a lower net profit.